Dear students, good evening again. Today we are going to discuss the International Accounting Standard number 2. International Accounting Standard number 2 is related to the inventories, or in the simple words we can say the stock. So it is basically related how the inventories are presented in the books of the account, how it is calculated, how it is debited and credited, means the accounting entry. So in the first lecture, in this lecture, we will just discuss the basic concepts of the inventories. Then in the next lectures we will discuss that how this net realizable value is calculated. Then in the next lectures we will see that how the debit and the credit entries are presented. Then we have a concept of the either we are using the LIFO method, FIFO method, or the weighted average method. Obviously the FIFO method is not allowed as per the International Accounting Standard. So the FIFO method, the first in first out method, and the weighted average method, how these are calculated. Then we will also discuss about the different type of the disclosures that are needed. So it is a series of the lecture related to the International Accounting Standard number 2. So we will just start with this. First of all, what is International Accounting Standard number 2? It is related to the inventories. Now these are the basic three things that we have to consider while discussing the concept of the inventory. So what is the inventory? Anything which is held for sale in the ordinary course of the business. For example, if the bookshop is there, so what they are doing, they are selling these board markers. So the inventory which they have, the stock which they have at the end of the month or at the end of the year, so that is considered as the held for sale in the ordinary course of the business. Now the second option is that is the in process for the production. Sometimes the company is not just a purchasing and the selling, they are not trading business, they are the production business. So they have some production processes there. They purchase the raw material, they transfer it to the or transform into the work in progress, and then finished goods. So if anything is in the production process, so the gain that will be included in the inventories or under the IAS number 2. The third thing, some of the companies are not providing the goods, they are not providing the production. So what they are doing, they are just giving the services. So any supplies which are used in the services, so those supplies also will be considered under the International Accounting Standard number 2 inventories. Now we have a main 5 heads that we have to consider. The first one is what is the merchandise. Merchandise is simply goods which are purchased for the resale purposes. So anything that the company or the business is purchasing, and the purpose is what, that they will resell it. So that is called as the merchandise. Then we have a production supply. Sometimes there are small materials like indirect materials or any other supplies which are available for the production company at the end of the year. So that will also be included in the International Accounting Standard number 2. Then the most important thing is the raw material for the companies which are the manufacturing companies, the basic direct material or simply the raw material, either it's a direct one or the indirect one. So all that materials which the company is possessing for what? For the production purposes. So for example, the wood is there, the steel is there, the plastic is there, rubber is there, or glass, so any basic ingredient, so it will be considered as the raw material. The next one is work in progress, means sometime at the end of the year some material isn't in the process. Process means it is semi-finished goods. It is started but not yet completed. For example, if the company is for the manufacturing of the shirts, they are just stitching the shirts. They have cut all the fabric, but still it is not a complete shirt, or it is not packed, so it will be considered as the work in progress. So it will also be under the International Accounting Standard number 2. And the last one is the finished goods. Obviously those goods which are finished, which are completed but still not sold, so that will be under the International Accounting Standard number 2. But there are some items which we have to exclude. Exclude means some of the items are not under the International Accounting Standard number 2. The first of all is the work in progress, but for what? For the construction contract. This is IAS number 11. Construction contract means what? That the companies, for example, they are getting the contract for what? For construction of, it may be for the construction of the building, it may be for the different type of the roads, or it may be for the different type of the bridges. But it is not for them, it is for the client. So anything which they are producing which is in progress but not their own property, so that will be considered as the construction contract. We will discuss in IAS number 11 in detail in the next lectures, so it is not included. The next thing is the financial instrument, IAS number 37. Financial instrument, anything which is directly related to the cash or even the instrument for the payable, so all these things will not be under the inventory. So if the company has any type of the inventory like that, so it will not be included. And the last one is the IAS number 41, the biological assets. The biological assets mainly relates to the any animal product or any type of the products related to the harvesting products. So again, IAS number 41, so we will discuss that standard in detail, but these three things are not included in IAS number 2. So we have to treat them according to their own specific standards. Now, the first of all, we have to consider here that whenever there is a goods available, either it is a merchandise, it is a work in process, finished goods, or the supplies or the services. So when we are presenting them in the financial statements, how we will present them? What will be the value which will be presented for the closing stock? So we have two things. First is that is the cost of that inventory or the cost of that merchandise or the cost of that finished goods. And the second thing is the net realizable value. Now, then what is the rule? The rule is whichever is less. Just for the example or for the understanding purposes, let's say that the cost is 20 and the net realizable value is 21. In that case, obviously 20 is less, so we will show the inventory in the books of account at 20, not at 21, because it is less. But for example, this value is 19, then we will show the statement in the financial statements the inventory value as 19, not as 20, because it is less. So we have to compare the cost or net realizable value, whichever is less, it will be considered. Now, here we have to consider that what is included in the cost, how cost is calculated for the inventory. So first of all, the cost of the purchase. The cost of the purchase has a many, you can say the subsections, or then you can say the ingredients are there. So first of all, the purchase price. If the company is purchasing, for example, a mobile phone for the $100, so that is the purchase price. Then obviously if it is coming from outside the country, like it is importing, so what they have to pay? They have to pay the import duties. So we just assume that the $100 is the purchase price. They have to pay $40 as the import duties. Let's say the internal taxes are $10, then the transport is the $20. So all these amounts will be included in the cost of the purchase. So it is not only 100, the purchase price of the mobile phone, but it will be considered as 160, 170 and 20, that is almost 190. So the cost of the purchase will be almost $190. Then any type of the trade discounts are there. So as we know, we have discussed already that there are two types of discount. It may be a cash discount or the trade discount. So any trade discount is there, so it will be excluded. For example, if they are buying like a 10,000 units of the mobile phone, and the company, they have negotiated with the manufacturing company, they may give them like a $5 as a discount, as a trade discount. So we have to deduct it, we have to subtract it from that. So we have to minus it, so it will be 190 minus 5. So the cost will be considered as 185. So this is the cost of the inventory. So this is what we have to consider, not only the purchase price, but all the import duties, all the taxes, transport, and if any trade discount is there, we have to subtract it. Then what you have to include, this is basically for what? For the mostly raw materials or for the finished goods which we are purchasing. But sometimes there is a cost of conversion also. Cost of conversion means what? That you are purchasing the material and then you are converting into the work in process, or you are converting into the finished goods. So there is a cost of conversion, like a direct material, direct labor, and also the factory overhead, which may be allocated one, which may be a portion one, or maybe any amount which is for that specific product. So direct material means the raw material, the direct labor cost for the conversion, and also the factory overhead for converting that material into the finished goods. So all these costs will be included. This is mainly for what, when you are purchasing, purchasing and selling means for the merchandise purposes. But this is for what? This is for the work in process or the finished goods. Then there are also some other costs that we have to consider, we have to also add. Okay. There may be possibility that there are some non-production overheads are there for designing for a specific customer. Means specific customer says that this product should be according to this level, the quality may be changed, you may have a design may have changed, and the company may be paying some of the extra amount for that. So any non-production overheads for the designing or for any, this is just an example, so that amount will also be included. So we have three things are there for the raw materials, the basic cost, for the merchandise, the basic cost plus any transport duties, any taxation and all the things. And if there is a conversion, so if the production company, so the material cost, the labor cost, and all the factory overhead costs. So what is material, labor and overhead? Obviously we have done this already in the previous lecture, so you can see, you can understand the concept of material, labor and the overhead. And still if you have any confusion, you can ask me in the comment section. Now we have three main options. The first one is for the basic raw material or merchandise. This is for the production purposes, and this is for any other cost which is related to the non-production overheads are there for the specific customer or according to the requirement of the customer. But there are some costs which should not be included. Means this is included, the cost of purchase, the cost of conversion should be included, the other costs should be included, but some costs should not be included. So what are those costs? Abnormal wastage of the material. Sometimes the production process is there, they have a normal wastage which is like a 2%, 3%, 5% according to the company, but it may be like a 40-50% wastage due to the labor negligence. It may be due to the malfunction of the machines are not working properly, the quality of the material is not good, and there's a 30-40% abnormal loss is there, so it will not be included in the cost of the inventory. Then any storage cost, obviously when you are purchasing the goods and you have to store it somewhere, so any storage cost or the carrying cost will not be included in the inventory. But there are some possibilities that sometimes some materials need some specific like a atmosphere or the temperature, so that cost will be included, so that is not the part of these exclusions. So then there are any admin overheads, like they have an office for the administration, they have office for any accountant or other thing, so those costs for managing these inventories, so this will not be included. And the last one, the selling cost, means the marketing costs, again these will not be included. So these costs will not be included when we are calculating the cost of the material or the inventory or the work in process or the finished goods. So we have to include these three things, but we have to exclude these three things. While calculating the cost of the inventory, we have two methods which are allowed by the International Accounting Standard. Those methods are the first in, first out method and the weighted average method. We will do the complete calculation, how it is calculated, how to prepare the inventory cards in the periodic inventory system, and how it is calculated in the perpetual inventory system. We will do the complete lectures on that. We have different methods, the first in first out method and the weighted average method. But there is one more method that is normally known by the students, that is the last in first out, but now it is not allowed by the International Accounting Standard, because in most of the countries or in the overall, due to the economic conditions, the prices are increasing, so they have not allowed it. And this is why we have only first in first out and the weighted average method, and we will do the complete calculation for that one. Now the cost is there, how it is calculated, what is included, what is not included, what should be excluded, and what is the method to be used for the first in first out and the weighted average. We will do it in the complete. The next thing that we have is the concept of the net realizable value. We assumed in the start that the cost, which includes all these things, is the $20. Let's say the net realizable is $19. But how this net realizable value is calculated? Net realizable value is simply the selling cost. The selling cost is basically what is the market value, the current market value of that specific inventory, less any estimated cost of the completion and any estimated cost to make the sales. For example, company have purchased a product, okay, and that time it was a raw material like a $10, $20, $30, the material is there, and now it can be sold in the market for $20, for $30, for $40, any expected or current market value. So we have to consider that what is the current market value and any cost which is there for the completion. Means it cannot be sold in the same condition, we have to complete it, and also there is some cost to make the sales. Means there may be some like extra cost which they have to pay, the like a commission or any other cost which they have to pay to make it sale. So for that purpose, if any cost is there, so what we have to do, we have to subtract it from that one. For example, the selling price is, let's say we have a $22, okay, and all these costs are what, these are $3, so 22 minus 3, so it will be $19. So this $19 is what is the net realizable value. So now what is included, how it is calculated, what should be considered while calculating the selling price or while estimating the selling price, and what is the cost of completion, what is the estimated cost to make the sale. So, and how this net realizable value is calculated, we will do again the complete lecture on that one, but this is just for the basic concept that the net realizable value is the selling price or the market value less any cost to make it sell. So that is why that is the net realizable value. Then the company or the business has to compare that what was the cost considering all these factors and what is the net realizable value considering all these factors, and then they have to compare. And they compare it, then for example, if it is 20 and this is 19, so whichever is less, so they will write it at the 19 in the statement of financial position, in the income statement as a closing stock, and also in the statement of financial position as the current asset. So this is how, this is the basic concept of the inventories, what is included in the inventories, what is excluded in the inventories, what is the cost of the stock or the cost of the merchandise or the finished goods, and what is the net realizable value, and what should be included in the cost of the material or the inventory, and what should not be included in the inventory. So this is the overall concept of the inventory. In the financial statement, like a income statement or the statement of financial position, because this is the closing stock, obviously it should be presented both in the income statement and in the statement of financial position. So how it will be presented, what will be the accounting entries for that, what are the disclosure requirement, and how the first in first out or weighted average, and how the net realizable value is calculated. So we will calculate all these things and we will discuss in the next videos or in the next lectures. I hope you have a basic concept of the inventories, IAS number 2, but still if you have any doubt, if you have any question, you can ask me in the comments section. Thank you very much.